Hi, my name is John Dowdy, and this is a market review of the stock market for the week ending April 12th, 2013. And what I'd like to try to do is to answer a question: is the current bull market that started back in 2009, is it long in the tooth? In other words, is it getting old and about to roll over? After this presentation, if you'd like to get some more data, then please come to my website, www.superchargedretirementIncome.com. Okay, so to try to answer these questions, let's look at the market. Okay, this is a plot of the market on a daily time frame. And as you can see, we're in a definite uptrend between these two green lines. Since November, we've been in a strong uptrend. And we've moved in 5 waves. 1, 2, 3, 4, 5. Now, according to Elliott wave theory, markets tend to move in 5 waves, and then they become exhausted, and then there's a correction. We'll see if that happens to this market. We will not know until the end of this 5th wave. An important thing happened last week in that we broke out from the range. We made a brand new high and then had a pullback on Friday. This is not unusual. As long as we maintain this new high, we'll still be in breakout territory. And in order for the bull to roll over, we'll have to go back below this red line. To put this in a little more perspective, let's look at the weekly time frame. This shows the market back to 2006. And as you can see, we had a market top in 2007. And right now, last week, went above that all-time high. We made a new all-time high for the S&P 500, which is quite an accomplishment. But as you can also see, since 2009, the market has moved up in 5 waves. 1, 2, 3, 4, 5. Within the last 5-wave period, we've also moved 5 waves. 1, 2, 3, 4, 5. So we've had 2 5-wave moves. So this gives us a clue that we may becoming exhausted. Doesn't mean it's going to roll over in the next week or month or even several months, but we are entering a territory where we would expect to get a significant correction. Now let's take a look and see how this market compares with other bull markets in terms of length. This is a chart that's based on data compiled by Investec, which is a membership site that I belong to, and this data was compiled by them, and I've reformatted it here for you. But this shows the length of bull market since 1930 and the number of occurrences. There have been 15 bull markets since 1930. One of the bull markets lasted less than a year. One lasted over 9 years. That was in 1990. That was the longest running bull market. In total, 15 occurrences. Most of them have been about 4 to 5 years long. 4 have been in that category, and that's currently where we are now. We're just a little over 4 years, about 4.1 years for this bull market. So it wouldn't be surprising, again, if this bull market continued on this year, and then potentially maybe 2014 would begin to have a major correction, or maybe even move into a bear market. Now also, we gained 10% during the first quarter of this year. And that was excellent gain, but it was not extraordinary. As we look here, since 1950, there have been 9 first quarters that gained over 10%. The best was 1975 that gained over 21%. And the second one was 1987 that the first quarter gained over 20%, but of course we gave it back in 1987 because of the Black Monday crash in October of 1987. But in any cases, of the 9 first quarters that have gained over 10%, all but one, that was 1987, had a very positive last year. In other words, we added the gains in every market except for 1987. But there's also another interesting statistic. That is, in all 9 of these cases, there was at least one 5% correction before the end of the year. Now, we have not had a 5% correction now. And so I would expect that sometime this year we will have a 5% correction, even though the bull may continue to run for a little bit longer. Again, this data was based on data from the Investec website. To end here, let's look at one more chart, and this is a zoomed in version of the S&P 500, the SPY, showing us from the 2013 view, just from January to today. And as you can see, from March for the last few weeks, we've been in a trading range between 153.59 and 157.21. This trading range was 3.62 points. As we have talked about, on Wednesday of last week, we broke out of that range and made a new all-time high, had a pullback, which is not too unusual. Now, because we have broken out of this range, the technical analysis says that we have a target that we can shoot for. This is called a measured move target that should be 3.62 points higher than the breakout point. So that we would expect this market to go to 160.83. So if I had to guess what would happen over the next few weeks, we will meet that 160.83 target. But sometime over the next few weeks or months, we will have a pullback of 5% or more. So to answer the question, is this market long in the tooth? Yes, it is getting pretty long in the tooth, but it's not dead by any stretch of the imagination. It still has legs, it's still going, and until the price action begins to roll over, we should give the benefit of the doubt to the bull. But we will be expecting a correction sometime this year. This should be a buying opportunity and not necessarily the return of the bear. The bear, I would expect, will not be around until maybe next year. Now, just as ending, the expression long in the tooth, you may be wondering where that came from. That came from horses' teeth. Horses' teeth continue to grow. So back in the 1800s, if you were looking to buy a horse, you looked it in the mouth to see how long the teeth were. If the teeth were long, then the horse was pretty old. So that gave you a good indication of how old the horse was you wanted to buy. So that is similar to other slang expressions like "don't look a gift horse in the mouth" and "straight from the horse's mouth." So that's just a little trivia to end this session. Hope everyone has a good week next week in the market, and thank you for watching and listening. Goodbye.